One of the other advantages, Ron, is no contribution limits. So one of the major benefits of using any kind of permanent life insurance for retirement is there's no contribution limits like you have in a 401k. So an example, in 2024, 401k limits, the contribution limit was 22,500, or if you were after the age of 50, it was 30,000. And what it does is those caps, those contribution limits, it makes it tough to save as much as you'd like to save. But if you have a properly structured permanent life insurance policy, you get to contribute as much as you want without any government imposed limits. So, what it does is it allows you to build up cash value more quickly. It gives you greater flexibility when it comes to your retirement planning. And for a lot of people who want to save more aggressively or diversify beyond a 401k, life insurance becomes an excellent option to do that. Plus, since there's no contribution cap, it offers more freedom to shelter income from your taxes and then provide you tax-free access to cash value during retirement as well.
Yeah, that can be an important factor for people because when you're talking about contribution limits, those that have higher wages or higher incomes, because of those limitations within those types of plans, they're looking for another resource or another avenue to add dollars, for because they're trying to build more buckets. We call them buckets. You're trying to build more assets. So these contribution limits that do have it is a restriction in terms of what you're allowed or capped out at as an employee. If you do have higher wages and you are in that higher tax bracket, um, a lot of times looking for an alternative that does not have contribution limits and like we've talked about has the ability to be tax free. This is something from a life insurance perspective that's definitely an advantage. Trying to build this bucket like we are talking about that doesn't necessarily have these restrictions to it, and then also give you the flexibility like we talked about from a tax-free perspective. That's an important combination.
Yeah, and I think, somebody has to actually look at this because a 401k, it's an employer funded plan. So the employer is going to contribute a certain percentage, and then, well, they're going to match you to a certain percentage typically. Um, and we're talking about funding the 401k, a lot of times we advise people to only go to the match, go to that money that they're giving you, that they're matching everything that you put into, but, try not to max out that contribution. So, when it comes to the contribution limit, a lot of people never get close to it. But if you are in a position where you can do that, you still have to think of that factor, in my opinion, of what are they matching, and do I need to do 22.5 or 30,000 a year in order to catch up in my retirement savings.
Yeah, I think just to add to that a little bit, when you mentioned that factor of the match that an employee might, I'm sorry, an employer might be offering an employee, anywhere from maybe a 3 to 6% match is what we typically see if it's available to them. When you start to exceed and go past, that 22 and a half, if you're under the age of 50, that limitation there of 22 and a half, well, that's well above that match threshold that an employer's offering you. People say, well, that's just free money in essence as the match. In theory, I would tend to agree with that because it's not your contribution, but anything that you're doing over and above that match, again, we talked about this before many times. You're just adding on to your own personal tax liability at the end because that is a deferral. You're not accessing that cash prior to a retirement age. So you're increasing your tax liability. It's a savings. We're not discounting that you're saving and setting aside money, but understanding that every dollar that's going into that is an increase in tax to you at the end. Again, I'm not going to get too deep into this because we've talked about this before, but and I don't want to get it into an argument. Well, we're going to be in a lower tax bracket versus not being in a lower tax bracket because we hear that all the time as well. It's just understanding that your partner is there Uncle Sam in terms of taxation. So anything that you're doing over and above the match threshold, just understanding all of it is taxable. But yes, are you reducing your tax liability currently, but are you increasing your tax liability for the future? You don't know the answer to that more than likely today if you're 30 years out from retirement.